Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights, with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Hello, and welcome back to ETF Market Insights. I'm your host, Erin Allen with BMO ETFs. And in today's episode, I'm joined by Pattie Lovett-Reid, who's going to walk through the 10 steps for developing a millionaire mentality, really unpacking what the ultra-rich do differently and key things to remember in our quest to becoming financially independent. Before I do get started, I want to just do a quick reminder that we're not providing investment advice or recommendations. As always, today is all about providing information and education for Canadian do-it-yourself investors. So Pattie, thanks for joining me today. It's so great to have you. For those of you who don't know, Pattie is a personal finance author and media personality. She really is a household name here in Canada.
That's very kind.
Former financial news commentary on CTV. You've been on BNN, The Social, CP24. You're in everyone's homes, really. So I don't think there's going to be anybody who doesn't know you.
But I also just want to say I started my whole career at Bank of Montreal as a teller. Yes,
That's
and it
right.
was great.
Your world is coming full circle.
Full circle. I love it.
And you're also a certified financial planner and co-author of a number of books. So you have years and years of experience, and I'm really excited to tap into your wealth of knowledge here. And I know you're just getting back from vacation, so we'll take it easy on you today. But thanks for being here.
Okay, good. Okay, take it away.
All right, so we all want to be financially independent. I'm excited to talk through some of these key mindset qualities that you've determined for the millionaire mentality. You have a list of 10. We're going to put a slide up. We're not going to have time to get into all of them, but I want to dig into a few of them that I really found interesting.
Okay.
And the first one being really that importance of focusing on your asset allocation. So walk us through, how this is sort of one of the only things you can control, and really what can the impact be to your financial situation?
Erin, I learned a long time ago that in order to make diversification work, and that's how much money you have in cash, in stocks, in bonds, maybe in the global markets, etc., and alternative types of securities, it all comes down to asset allocation. And what I learned from the ultra wealthy is they don't have all of their money in one stock, one country, one particular sector, and never mind that, they don't even, when it comes to currency, they diversify with currency. So asset allocation is really, really key. They also pay attention to fees, and fees make a big difference in a portfolio over time. And one of the reasons I think I mentioned to you that I like ETFs, and they're very popular in that you can have a basket within a particular sector, but the fees make the difference sometimes, particularly in markets that seem volatile. I started all of our children out in actively managed funds. And when I say children, they're in their 30s and 40s. And they said, okay, it's a good place to start, Mom. And as they progressed, as they watched their money grow, they then came back to me seriously and said, why am I in this particular fund as opposed to this one where the fees are less? And I said, that's entirely up to you. It's a basket of stocks. And if you're happy, and they have some in the financial sector, they have a balanced growth. You see where I'm going with it.
Yeah, I think that's so true. And the asset allocation is important to stick to too, right? And over time, your portfolio is going to drift. So you have to make sure that you have a cost-effective way of, bringing it back to that original asset allocation mix that you chose. And as you mentioned, ETFs are really effective in that way. And also they trade for free on a lot of platforms now. So you're really not
Yeah.
spending a lot of money to bring yourself back to that asset allocation that you've
Can
selected.
I just talk about that? Because I think you made a really good point. Your asset allocation is not carved in stone. I mean, there were decades, which you very kindly alluded to, when I was working and I was in asset accumulation mode. And so, as our confidence grew, our risk tolerance grew, and so did our portfolio change to a more aggressive stance. I'm supposed to be retired, which I don't think I ever will be, but there is a difference between wealth accumulation and wealth protection. And it doesn't mean that the particular types of investments necessarily change, but my asset allocation has.
Right. Absolutely. Not set in stone.
No.
And then, of course, one of the other, maybe most obvious ones that you kind of alluded to is the fact that we need to curb our spending or focus on asset accumulation. I have problems with
Yeah.
these, especially during Christmas time. But how do you
Mhm.
suggest investors practice this? Any tips from your perspective?
One of the jobs I enjoyed so much when I was in the financial services industry was talking to those who had over $25 million of investable assets. And so I would sit down with them, and I did that job for about a decade. I would go into different regions, different locations. We would do a big presentation on what was going on with the economy. And then some would sit down and say, okay, what does this really mean to me? And one of the things that I found along the way, because you would observe and I would think, what do they do differently? And they are very frugal. It does not mean that they're not cheap, but just because you can afford to spend doesn't necessarily mean you should. And never are you, as an individual, going to prop up the Canadian economy by doing your part and spending and spending and spending. The other thing I found fascinating, Aaron, is that don't judge a book by its cover. One individual I met with for literally a decade, we would go to lunch every time I went into the region there. And the first time I saw him, he was in a red cashmere sweater, beautiful pants, shoes, like he was pulled together. The next year, Aaron, he had the same outfit on. And the next year, the same outfit. And for a decade, when I finally told him, I said, I'm not going to be meeting you anymore. He laughed and he said to me, well, thank goodness my wife has threatened to throw this outfit out for almost 7 years. And that's when it dawned on me. And of course, he could afford a new outfit. But in his mind, it was perfectly fine. And he was making a point, and the point was made.
Yeah, they're razor focused on cost. You're often going to see them
Razor.
wearing t-shirts. It's so
Right.
true. You're not seeing the millionaires with these, lavish belongings
Demonstrative.
mostly. Yeah.
Yeah, you're right. You're right. Yeah.
You also highlighted how it's important not to sit idly in cash. And I think a lot of investors have built up a lot
Yeah.
of cash over the past year because there's been a lot of uncertainties. So, remain invested. But you also talk about the importance of having an emergency plan. So, how do you really balance those?
Right. Well, here's the thing. Sitting in cash, and it's never been more true than the last few years, taxes and inflation erode your purchasing power over time. And so you work hard for your money. I really think you want your money out there working as hard for you. And that means, to your point, Aaron, that you stay invested. And sometimes that can be really hard to do. And that's where you don't allow your emotions to dictate your investment decisions, but the plan that you put in place doesn't mean you can't tweak it, because you certainly can. Now, what I found with these individuals that were ultra wealthy, they often had an emergency plan. That didn't mean that they sat in cash, but what it did mean is if they needed access to money, they had it. And they didn't want to have to sell out of an investment at exactly the wrong time because they needed money for something else. And so when I asked, and I have asked this question, what happens if something happens? What happens if there's a financial speed bump or detour? They would have a line of credit that they would never use. They would have a credit card that was simply used for an emergency. They never, ever would go into debt to enjoy an experience. But they said, there's nothing wrong with taking on the right amount of debt that you can afford, that you can manage in order to build an asset. If you're going to invest in yourself, in your company, in machinery, in your education. It could be in your home. So that there were parameters around debt, which they thought was a never-ending sinkhole, and using debt wisely so that it became part of your plan.
And I know there's sort of a rule of thumb in terms of how many months you should have
Yeah.
in an
Mm.
emergency fund. What do you think of that?
Yeah.
Does it vary per person or?
Yes, because it depends on the lifestyle that you have, how much money you need to bridge a gap of 3 to 6. And maybe in a market that's a little more challenging, it's 9 months or it's longer. And that can feel like a long time to have money sitting idly. And so, what I will say, it's sort of slow and steady. Build it up over time and then decide what you want to do with it. You may decide to put that money into a shorter term guaranteed investment certificate. In the meantime, you have access to bridge a gap, um, you know, if you need to via a credit card. What I can tell you is people don't necessarily worry about making their mortgage payment or paying their bills when they have a job. It's when all of a sudden you don't have a job. And in the markets, that it can be very volatile. Really good people lose their jobs all the time. And so I remember a doctor saying to me, Pattie, what's your plan B? And I laughed and I said, I don't need a plan B. I love what I'm doing and I'm going to stick with my plan A. And he went, no, that's the wrong answer, Pattie. It may not be your decision in life. It could be your health. It could be your parents. It could be your children. It could be your employer that decides you're not going to be here any longer.
For sure. We saw I think a record number of
Mhm.
flows, in our previous year, and still a lot of flows going into money market and cash alternative type products. So it's
Yeah.
clear that a lot of people are nervous of the markets right
Yeah.
now. But it is more about staying invested and not trying to time the market, I think. Would you agree in terms of building
Yeah.
wealth over the long term?
I mean, that could sound like a leading question, Aaron, and you
Yeah.
know what? But to be perfectly honest with you, yeah, it's not timing the market, it is time in the market. And I've done so much reading over the years, and it just proves time and time again that you will compromise the returns on your portfolio, if you try to time the market, because when you time the market, you have to get it right twice, not only when you get out, but when you get back in. And another rallying cry for ETFs, because I will say sometimes on an active management side, they have a hard time getting it right both times, and they're professionals. So, you may have a really strong performer in your portfolio, you may not, and you can't fall in love with your assets, which is why when you have a basket, it offsets what does well, what doesn't do well, and you continue to move forward.
What do you mean by you can't fall in love with your investments? Talk to us a bit more about that.
Yeah, you can't fall in love with your assets. No, you can't. Nobody buys into an investment thinking in all likelihood that it's going to go down, but it could go down. And if it does, people will say, I'm going to double down. I'm going to invest more money because I still believe in it. I still think it's going to come back. Now, it might if the fundamentals have not changed. Sometimes a particular company gets carried downward along with everybody else in the sector. But that isn't always the case. And so sometimes you need to understand when it's time to sell a particular investment, take the loss, offset it against a gain. There's an opportunity cost hanging on to something that isn't performing well for too long in your portfolio.
For sure. That's why I really like these all-in-one asset allocation ETFs because they
Yeah.
really take all the emotion out of that,
Yep.
rebalancing decision when, investors over the past year probably saw the US market going up and said, I am not selling any of that. But really, in their best interest is to reallocate some to the underperformers. And so that's a great
I
tool for
know. And
beginners.
it's such a hard thing to do emotionally. This is doing well. I'm going to, lock in my gains and reallocate, which, Aaron, gets back to your original conversation that said, talk to me about diversification and asset allocation. If you stay true to your asset allocation, it is exactly why when something does particularly well, You pare it back and you go into something, maybe it's stocks sometimes, maybe it's bonds other times, and maybe it's a particular sector. So it does balance it out.
For sure. You also talk about, it's a particularly noisy time right now, but you talk about avoiding the noise when it comes to
Yeah.
your plan and your investments. Talk to us a bit more about that.
Yeah. Yeah. Even when I was on TV, I would often laugh and say, and I'm still on TV, but like not every single day talking about the markets, turn us off. Turn off the noise. I'm not sure I'd be employed long term with that kind of attitude. But yeah, when you think about it, okay, let's talk about an all new station, anyone. And think about the number of hours of programming they have to do. And the guests are going to vary because they want to capture your attention. And so they may be outrageous. They may be outrageous conversations, but it doesn't mean, for example, your grandmother should be investing in it. And so that's where you have to strip out the noise, the commentary, and get back to basics, because any sort of financial plan that you have is not a cookie cutter approach. It's not one size fits all. And you may think you have two, let's say 50-year-olds, they may be living in the same neighborhood, same cars in the driveway, you think they're identical, they're at the exact same spot, but you don't know what they've been through. And there is a lot of keeping up with the Joneses. Or you hear a high flying particular stock, it might be in the tech sector, and you think, maybe there's still some room to go. I'm going to get in now. If it's not with your plan, back up. Back up. Don't compare. Don't look for the big wins, the short-term opportunities to make up for lost ground.
So true. A lot of people are looking for that next stock to talk about at their dinner parties.
If we talk about Bitcoin, yeah,
Yeah.
I mean, think about it. My son even called me, and I laughed, and this is what I did say. He said to me, it's hit 100,000, Mom. I go, yeah, I know. And he goes, do you think it's too late? Like, maybe I should buy. Maybe I should get a Bitcoin ETF, get a crypto, look at things differently. And I said, sure, because I guarantee you, if you can afford 100,000 to just invest in a coin, you and I need to talk. Yeah.
Oh my gosh. Yeah. I think that's another one for your list. 11, avoid the FOMO, the fear of missing out. There's a
good one. Yeah. But there's truth to that, Eric. That is a great comment. Yeah.
For sure. Well, thank you so much for joining me, Pattie. That was a great overview.
Thank you.
Anything we missed in terms of the millionaire mentality that you wanted to highlight before I let you go?
I will. You know what? I will say this. They worry about a legacy. And I can tell you the legacy isn't about the money. A distribution of assets, if it's done fairly and done properly, is easy to do. But the legacy that they really want to leave behind is how they're going to be remembered. And it is not necessarily about the amount of money they've accumulated over time, because there comes a point where they say, I do have enough, but it's the bigger picture, it's the legacy. And the next big thing, they always think this, is right around the corner. Like right around the corner. We just have to be open to opportunities. I think the next big opportunity for me, right around the corner. I mean, how crazy is that at this stage in life? But it just might be if you're open to it.
It's all about the mindset. I love that. Thank you so much, Pattie. You bring so much energy and such a wealth of real life inspiring stories and guidance around how we can all, get to the next stage in our financial journey. So thank you for joining me today.
Thanks for having me, Erin.
That's all for today. We will be back next week for our quarterly bank earnings episode. So thanks for joining us, and we will see you next week. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.